Hello everyone, Wall Street Warrior here. Today we're going to discuss Moody's downgrade of 10 USA banks. I'm a little late to the party on this one. It did happen a few days ago. It's an interesting topic and I wanted to really take my time, gather the info and put a decent video together on this one. A lot of people got a lot of hot takes on this one, what it's going to mean going forward. I'm not going to make this an opinion-based video because my opinion on it is, as worthless as everyone else's. We don't know yet what's going to happen. So this is going to be a factual video. Okay, so we're only going to say what's happened, what it could mean going forward. I'm not going to tell you what it's going to do because nobody knows. Okay, so as I say, it's a very interesting and in-depth topic. So today, what we're going to cover is we're going to cover what is Moody's, for those who don't know, why did they downgrade these USA banks, what it's done to the markets so far, what it could mean going forward, and what it means to your average individual with a bank account. Okay, so what is Moody's? Moody's Corporation, basically it has its holding company, which owns securities and fixed incomes, and also it has Moody's Analytics, which provides the software and research for their risk management, economic analysis, and they are classed as one of the rating agencies. Okay, so credit ratings are predominantly provided by three main agencies. So we've got the S&P, which is Standard and Poor's, Moody's Investor Services, and Fitch. They're the big three credit rating agencies. So when one of these big three downgrades something, people pay attention because they're the big three. Moody's Investor Services provides international finance research. So when Moody's speaks, the market is wise to listen. Okay. Now, when they originally covered this on Bloomberg, they did not make a big deal of it because their original criteria, Moody's original criteria for what they said it would have to take for them to downgrade US banks, they didn't actually hit that criteria, but they did it anyway. Okay. So now going to move on to why they did this. Why did they downgrade USA banks? The three main reasons are higher funding costs. This is obviously linked to raising interest rates. Potential regulatory capital weakness, i.e. not having enough cash on hand. And exposure to commercial real estate, a sector which we have seen suffering lately. So these three things combined are the main reasons for the downgrades. Here's a little snippet of a statement Moody's gave on the day they actually they announced the downgrade. So collectively, these three developments have lowered the credit profile of a number of US banks, though not all banks equally. Okay. Through their analysis, they've seen that these banks have large positions with unrealized losses. So what this means is these banks will have open trades that is in a position that is not going well. As I call it, offside or in the red, right? They are going to have open trades on whether it be commodities, debts. Obviously, we can't see every ongoing trade that a bank has, but Moody's has analysed what they've got positions in, how poorly it's going for them, and they've seen them as a risk. Okay. So these banks are in trades that are not going well as their current capital levels, i.e. cash on hand, is not where it needs to be. So what they're essentially saying is, could these banks pass a stress test or survive a long recession? Furthermore, okay, not just these 10 banks have been downgraded, they are also looking at a dozen other large banks, such as Bank of New York Mellon, and are also under review by Moody's for a potential downgrade. So although we've seen these moves happen already, there's potentially more to come. So, what has it done to the markets so far? Here's a quick screen grab of a chart showing the US 500. These are daily candlesticks, by the way. As you can see, all we can say for certain so far is that the bull market has taken a pause. Will it reverse? Do you think it's just a minor setback and the bull market will continue for the remainder of the year? Do let me know in the comments. Honestly, I'm on the fence on this one. It's tricky. There's been a lot of good data overall in the markets. Jobless figures, non-farm payroll. The Fed has said it's going to be data-driven going forward, and the data has been good. Could this be enough to stop the bull market or even reverse it? So it's an interesting call. Originally, these downgrades was not called a big deal on Bloomberg. When this originally broke on Bloomberg, they did not make a big deal of it. They actually downplayed it for a while. Actually, it makes many of the banks and therefore the financial sector of the S&P 500 way less attractive to investors, especially in the short to medium term, therefore weighing on US indices and having a broad-ranging negative effect on US markets. When we say US financials on the channel, what we're actually referring to is basically the US banking stocks, just to clear that up, okay? So, what does this mean for the markets going forward? This could end up being something systemic that causes a tidal wave of short selling, therefore reversing the bull market or even causing a bear market. Or, as we said before, it could just be a stagger step in the market. Right now, we're seeing indecision. It's difficult to say if this is going to be something that causes a long-term trend or a stumbling step. Only time will tell. What it could also mean in the future is that we're going to see more small or medium-sized US banks merge in the very near future. Either way, the US financial sector is going to see some changes. That much is certain. So, what does this mean for just an individual with a bank account who's not necessarily an investor? Well, largely, not a lot. The US economy is still very strong. Don't worry about it too much. The checks and balances the banks put in place after the 2008 crisis are doing their job. But it may signal an economic downturn to a small degree or a possible era of reduced growth. In summary, it's a fascinating topic. The most interesting thing for me is that Moody's original criteria of what would have to happen for them to downgrade banks wasn't met. Although, to be fair to them, based on the data available of the positions the bank held, the ring-fence capital they have, and their potential to pass a stress test, they acted quickly to downgrade them, which, although it caused a bit of a shockwave in the market, was probably the right move considering they are a ratings agency and they were on top of keeping an eye on the financials. Let me know down below in the comments, do you think this is a short-term stumbling stock in a bull market, or is this the beginning of a minor 2008, possibly confined to just the banking sector and not the whole global economy? I'm really interested to hear everyone's thoughts on this one. Honestly, I don't know what it's going to mean for the banking sector in the next 12 to 18 months. This has been Wall Street Warrior. Thanks for listening.